tonight, as I said, it's beef and all things financial to do with beef. And just to tell you the two topics that we are covering, I'm going to maybe spend about 10 or 12 minutes looking through the cattle beef budgets that we produce each year. They're a little bit later this year, weren't available at the Plough match, but we have them now, so I'll go through those. But I suppose the main talk and topic we want to discuss tonight is looking at the whole area of maybe reducing your tax bill for 2025. It's something we might often discuss, in beef situations where the profits don't be that high. But I suppose this year might be a bit of a transition year. Cattle were bought at different prices last year and maybe even the start of this year, and now the thing has moved on well. So we're trying to cover that area, and we're delighted to welcome Aisling Funchion from IFAC in Kilkenny. You're very welcome, Aisling. So you're
Thanks a million,
there.
Terry.
Thanks, Aisling. Okay. So as I said, we'll be handing over to you shortly to go through. I know you have a number of slides to present on possible tax saving issues that farmers could take on board for the remaining few months. So what I'm going to do is go through the budgets I have in front of me. And to be honest, I have a good few budgets, so I'm not going to go through a good few budgets. I'm going to try and have it wrapped up in 10 or 12 minutes. Just as by way of introduction, we do have a Q&A facility there. It's on the bottom middle of the screen. We would encourage people, put in your questions. And any questions, we have Mark Trimble in the background who's directing operations. Mark will maybe throw a few questions to myself, and when Aisling comes on to Aisling. We're reading out no names, so any question you put in is totally anonymous, and we just ask the question, and hopefully either myself or Aisling will have the relevant answer. So do not be afraid to put in your questions. Right, that's taken me on, I think, to maybe my topic, and just by way of introduction, and we say this every year, and we really say it strongly again this year, these beef budgets are guideline budgets only. The only budget that counts is your budget and the way you conduct your operation with the whole area of buying animals, your feeding expenses and regime, and the way you sell your animals. So your budget is the proper budget. I'm just putting up a couple of sample budgets, what we've done up, and you can just take from it what you may, and you might take nothing from it. As I said, it is a little bit of a transition period at present because we've probably bought cattle. Anyone with cattle from last year were bought a lot cheaper than you buy them now, as you know yourself. And even at the start of this year, what looked dear might seem cheap now. But look, the reality is, and I was talking to a man the other day that maybe is doing heifers and bullocks, and he was actually having €1,000 of a difference from the heifers he bought last year to start this year to what he's selling now. But what he's buying back is costing €500 more to replace the heifer that he's selling. So really his gap is €500, not €1,000. And that's the reality, as you all know yourself. And when we get up and running in this hopefully higher price regime that's here to stay, they'll be the obvious sums that we'll be doing, and the gap will be a lot narrower than it might be for the one run of cattle we're selling now from bought a while back. The other thing I'm going to say is we obviously have fixed costs in these budgets, and again, they're hugely variable on farms, and for some people that's maybe only have built sheds or bought machinery, they can have very high fixed costs, and your neighbour down the road might have older sheds that are fully depreciated, maybe older machinery. So while we've in fixed costs, you have to take them with a pinch of salt because they vary hugely. And the ones we have in are actually low enough, so you could argue we possibly mightn't have enough in anyway. So I'm going to look through a couple of budgets here, starting with the winter finishing budget, if you like. So we're buying that forward store to beef steer there. He's sort of spring last year born, so he's a nice store now that we're hoping to finish over the winter period. We have a purchase weight there. If you follow down the slide, the Continental Bullock first, 520 kilos there. We're shoving them a little bit harder now than maybe we used in the past. So we're saying for 120 days, we're going to put 150 kilos on that bullock. The bullock on the right there, we'll do him in a minute, is a dairy cross animal there, maybe an Angus or a Hereford. He's a shorter period. But the Continental, 120 days, we're putting on 150 kilos live weight. You can see the silage there involved, 3.3 tons. We're going on 6 kilos a meal. I know there's some of you out there would say 6 kilos is too low, and there's equally people with maybe feeding 4 kilos a meal. So we're going for 6 kilos. Again, it's only our shot at it. You know, what you do yourself, it's your own business. Live weighted sale, then that bullock is going up to 670 kilos there. The 520, 150 gain, it becomes 670. And it's a good bullock. We're buying an R plus bullock, a 56% kill out. He's killing out 375 kilos. So now back down to the monies. Purchase weight. So 520, what are we paying to buy him? And straight away you might look at this figure and you say, that lad is out of touch. And that's fair enough. The price we're putting up there is taken from the last 2 weeks of August and the first 2 weeks of September, and it's the average price for those bullocks from the Farmers Journal. And that's a while back, the last 2 weeks of August, the first 2 weeks of September. I know from standing in Marts and Ringside, in general, they've gone up considerably. So, I mean, we'll build that into the price that towards the bottom. I mean, if that bullock, I mean, 520 kilos, we're buying him for 2,465. I know my heart and soul at €5 a kilo there, he's 2,600 and it mightn't buy him either. But if he's at 2,600, basically what that's saying is you can add another 35 cents onto the price I'm going to show you at the bottom of this screen. So if he is costing at more, and I mean, you know, if he's costing more than that, you can stay at none. Coming on down then, variable costs, and I'll show you those in a minute. Variable costs are primarily made up of silage and meal, but there are a few other costs I'll show you at the end of this page. Fixed costs, €63 for the animal. Again, mainly made up of sort of depreciation, you know, running costs, interest on the loan. We're borrowing half the money to buy this animal. All those sort of costs that, you know, they're really there on the farm. They might be obvious, but you're the one that's going to be paying them. So total costs 500 odd euro. So the maths are very simple. You don't need a fancy sheet like I have to work this out. What you paid for the bullock, you add on your €503. So the break-even selling price there is a little short of 3,2968. And then if you're saying this animal is killed out at 375 kilos dead, well, divide that into the 2968, it says you need €7.91 as a break-even selling price for that animal per kilo. Now, two things. One, that bullock probably is costing more, if we're being honest today. So if you add on another 35 cents onto that price there, you can see very quick you're up to €8.26 if he is costing €5 a kilo. And that word break even, some of you might have a heart attack looking at that. Break even is making no money, and you're not going to go out and buy those bullocks and want to make no money. But again, like, who am I or Teagasc to tell you what profit you want to make from the animal? But let's just throw out a figure. If you wanted to make €150 profit from that animal, and you might say, geez, that's good, or you might say, I'm not bothering my head if that's all I'm making from him. That's your own call again. I'm just making up a figure. So if you want to make €150 profit, now that's effectively another 40 cents. So if he's costing a little bit more than we put this on the page, if he's costing a bit more, that means he's 826 to break even. If we want 150 profit, now he's 866 to have our profit of €150. And I suppose if it's an R plus bullock, you're getting the €20 quality assurance and the 6 cents for a grade. Basically, it's €8.40 of a base price, and add on your bonuses to give you 866 or €150 profit. So look, they're the figures I'm throwing up. They're higher than I'm putting on that sheet there. If you're able to buy the animal cheaper, fair play to you. If you're able to do the animal better, fair play to you. They're just purely guideline on our side to give you a sort of something to work with. Just quickly, and I mean, I'm not going to go through the figures in the same detail, but on the right hand side, we're buying that Angus or Hereford cross, 480 kilos, again, shorter sort of finishing period, less silage, a little bit less meals. In our example, maybe not on your farm at home. Carcass weight is going to be a bit lighter when you're killing them 300 kilos. Again, this is probably taking the average price for those animals back that period, end of August, early September, from the Irish Farmers Journal. look at again, they're probably costing more if we're being honest now than the price I have there. Again, you can start adding on. I mean, if the animal is costing €100 more than I'm buying them for there, well, that's effectively another 33 cent going on my red figure at the bottom, which is €7.80 as you can see. So it'll be another 33 cent if the animal's costing uh €2,087 instead of €1,987 there in that creamy colored line that I have there. And then again, if you're coming down further, you can see the variable costs, the silage meals, and a little bit for dosing and marketing that I'll show you in a second. Our fixed costs a bit less because we have the animal a little bit less. Again, we have a break-even selling price, which is giving you no money. It is 780, or effectively, if the animal's costing more, it's 813 if the animal's costing that bit more. And if we want to have our €150 profit here, given that's a lighter carcass, it's another 50 cents. So basically, I'm at 863 on the bottom line if I'm buying them for €100 more and if I want my €150 profit. Again, there are only figures that we're putting in there. It's what you want to call yourself as regards what profit you want, and then if you're held to buy that animal better than what I'm putting here, or buying for what is written on the screen, well then you can come back behind those prices. I'm not going to mind that there on the effective autumn stores up or down because I sort of covered that with giving a higher price. Just the assumptions there on the efficiency. And I mean, you know, as you know, this enterprise, don't take it on if you're not going to be a very efficient operator because you won't have a hope. So we're putting meal at €340 per ton. Again, some people maybe in big setups are buying the meal a little bit less than that. Other people may be paying more. We're looking at very good silage here, 72% DMD silage, well preserved, etc. We're valuing that at €45 a ton. I think if you did very good silage made like that, you might like to sell it for 45, but we're calling it €45 a ton. It's a continental steer, 1.25 kilos of a finishing period live weight gain, 56% kill out. You can see there why he's eating about 2%. The dairy cross animal, a little bit less in the finishing period of a gain. Obviously, those Angus or Herefords, look, we reckon to kill out around 51%. If you have different or better figures, that's 100%. We're not spending much on animal dosing, as you can see here, €6. And we're definitely not making up any lorry man or any commission anywhere at €40. You might get a whole lot of transport marketing done for €40. Half the interest there is borrowed at 7%. No mortality. You try putting 100 cattle together and having no mortality, and you really are a top operator. So these are all things that, you might have to adjust yourself. So look, that's all I'm saying about that. It's taking a big price there to have a little bit of profit, and you want all things going very well for you. I'm just going to go maybe, Mark, through one or two more quick things. I won't go into the same detail. This is looking at the forward store heifer. Again, buying that continental heifer at 500 kilos live weight and selling at 600 kilos. I had 330-kilo carcass. You can see in the green there. Again, we were purchasing that animal at 2,370 or €4.74 per kilo. I don't be standing the heifer ring as much as the bullock ring, so we might be out there as well. Again, adjusted as you see fit. Basically, I suppose every €100 is about 25 or 6 cents you may add on to the bottom line price there. Is the simple maths and that. So again, we could be wrong with all the figures, but we're coming up with a break-even selling price of 841, and indeed that could be 860 or 70 there, or would be if you want to have a profit, even if we're buying the animal right. So again, you're looking at base prices probably up around the 840 or 850 mark to have your little bit of profit out of it. Corresponding figures across there for the other animal. Again, I'm not going to look through that. That's just up and down the purchasing price of it. High efficiency again. Much of those figures are the same. That continental heifer, we were 1.15 kilos of a gain over the winter, a kill out of 55%, and her dairy cross compatriot there, I didn't go through there, obviously kill out a bit less, etc. Again, any of these budgets we can post out to people and you can adjust them yourself. This is looking at the autumn steer. Again, we're buying a 450 kilo Frisian, and you can see there in the pink, or in the fawny coloured line under the pink there, we're buying that bullock for €1,764. Look, that's probably about right. I'm seeing that maybe at the moment, maybe 1,800 for the good ones. The Hereford and Continental, I think the Continental probably not been bought for that in some marks, but again, it's up to yourself and how you can do business. So again, those figures I have there, this is a longer period, so one would expect a lower price. But again, if we're out with those prices, you may adjust it on as well. And obviously, they're break-even figures. So straight away, there's going to be 25 to, well, there's going to be 40 cent added on to all those figures to have a bit of a margin, I'd say, before anything's wrong with the buying price or whatever. So that's taking you up quite near the €8. Again, those things I'm not going to go through them. They're just the levels of efficiency there we hitting that. And again, we've other ones there. I think I won't go through any more, Mark, because the more you go through it, maybe the more you confuse people. I might leave it at that for now. And I think, Mark, you're there on the question. So thanks for your attention. And if there are a couple of quick questions, I can take them before we move over to Aisling.
Yeah, just a couple of quick questions after coming in there while Aisling gets set up, Terry.
I'll stop
The
sharing.
first one there, does any system particularly suit nitrates or stocking rates better than another one?
Yeah, look at and nitrates is obviously something we're living with, and there's some people in derogation, and there's lots of talk about that, but the majority of people are not in derogation. So your farming market, 170 kilos of organic nitrogen per hectare, and I suppose, look, system wise, I mean, you know, the maths aren't simple, and if you're taking a person buying calves and keeping them to 2 years of age, for example, and if a 0 to 1 year old animal counts as 21 kilos now in the full year. And a 1 to 2 year old animal, if it's a heifer, it counts as 55 kilos right through from 1 to 2 year. That's organic nitrogen per heifer for that full year in the 1 to 2 age category. And a bullock is about, is about 10% higher. He's 61 kilos of organic N per hectare for that full year 1 to 2 year old. And the over two is 65. So I suppose in simple terms, if you wanted to fill the farm up close to the 170 kilos of organic N and you had a 100 acre or 40 hectare farm, Mark, you could realistically carry, about 85 or 6 heifer calves and their followers for the year and stay under 170. Or you could carry about 80 or 81 calves and their followers in bullocks for the full year. So you'd have 170 animals on the farm, getting them all out under 2 years. You could do that, or if you're in a system where you're just buying year-old cattle and killing them at 2 years of age, and sticking rigidly to that and let them be that for the full 12 months, you could probably have three of those animals per hectare with heifers and probably 2 3/4 with bullocks. So, look, the figures need to be done out. I suppose in general, we're not seeing, maybe not everyone is filling their farm up to the stock and rate limit, but the people that are do have to keep a very close eye on that.
Okay, that's about it for now. We'll maybe hand over to Aisling.
Thanks.
Thanks a million, Terry. Thanks, Mark. My screen's visible there, is it?
It's not full
Yep.
screen, I think.
Went up to display settings there, yeah. That's it.
Great. Thanks very much. Thanks everyone for joining myself and Terry here this evening. As Terry mentioned, my name's Aisling Funchion, so I'm a partner here in IFAC Kilkenny. So no surprise, 2025 has seen record prices achieved for beef and suckler farmers. But unfortunately, with the record prices and the record profits, come the fear of high tax bills. So hopefully some of the measures and reliefs that we run through here tonight will give you food for thought in the hopes of minimising those tax bills, or alternatively managing cash flow in order to try and pay the tax bills as they come up this time next year. So what we're going to do firstly is just start off with the income tax rates and the cut-off points for this year as a starting point. So for a single individual, the first 44,000 is taxed at 20% and the balance is taxed at 40%. For a married couple with one income, the first 53,000 is taxed at 20% and the balance is at 40%. And this will be an important point as we go through the slideshow. A married couple with 2 incomes, the first 53,000 is taxable at 20%, with a maximum increase of 35,000 depending on the income of the spouse. The balance will be taxed at 40%. Just to flag, PRSI has increased to 4.2% from October, and USD rates do vary. They start at 0.5% and they work all the way up to potentially 8 or 11%, depending on your other sources of income and your total income. So just to flag as well, with the measures that we run through today, the 7 of them are on the screen, that we're looking at each of them in isolation. It might be a case that they don't apply to you, given personal circumstances. So the hope here tonight is that you take the individual incentive and see, can it work for you? Speak to your accountant, and hopefully they work towards bringing down that tax bill. So the first of the measures that we have tonight is income averaging. Now, for anyone not familiar with income averaging, it's not a tax saving measure, but more of a cash flow measure, which will allow you to group the last 5 years farming profit and losses together, resulting in you paying 1/5 the profits, paying tax on 1/5 the profits in the current year in 2025. So what it will do is increase the profit slightly over the coming years, but a crystal ball situation. Nobody knows where the prices are going to be over the next couple of years. And I suppose where this can really help is for farmers who haven't had high profits in the last couple of years. And it'll allow them to reduce the tax that's going to be paid for 2025 and make things a little bit more manageable. Also, what it'll help do as well is if you were planning on building a shed or some sort of capital investment on the farm that you didn't manage to get it done in time because of planning or for whatever reasons, it means that you're pushing out some of that tax liability to the future years that can be offset against that capital investment then, and again, just make things more manageable. So as an example, just to show how averaging works, we can see on this table that we're looking at 21 to 25. They're the 5 years we're going to be looking at. In this example, the profit in 2021 was 20,000, and it increases all the way to 42,000 in 2025, which is obviously a double. Now we can see the associated tax liabilities as they were, the 10,400 all the way up to the 21,000. So again, a double tax bill. We're looking at 52% of the profit being taxed. Or being the tax bill. So if we were to implement averaging, our 5-year average then reduces the tax liability for 2025 that we're paying tax on 27,000 as opposed to the 42, and that results in tax payable of 14,000 as opposed to the 21,840. This is really beneficial where the money is just simply not there. As Terry has pointed out in his budget, it can be hard to make profit in some years with the rising prices, and it can give everybody a chance to try and spread the impact of the high price year over the next 4 years. Okay. So moving on to stock relief then, which is one that everybody should be, I suppose, focusing on this year. One of the most common questions we're being asked this year is, what should I buy back in by the end of the year? Everyone's nervous about the high prices and they're wondering, what do they spend? Does it matter if they don't buy in? So as a first starting point, what we're going to do is explain stock relief for anyone that's not familiar with it. So what stock relief is an increase in the value, monetary value, from over and above the opening stock to the closing stock. Revenue will give an allowance of 25% as the general relief, increasing to 50% for a registered farm partnership or 100% for a young trained farmer. So this is for an increase of 10,000 in stock, you can potentially get 10,000 of a reduction off the profit for a young trained farmer, which is substantial. Now, ideally, I suppose in previous years, it's potentially, or the potential was there that the tax values have been pushed down on cattle to try and minimise tax bills. Now, obviously, the result now is there's a massive gap between what your current tax values are and where your profit is now lying with current prices. If you were ideally where you want those tax values to be is 60% of your market value, and everybody should be striving to get to those in order to have a consistent profit year on year. But the opportunity is there now to bring your tax values in line and also to buy back in the stock in order to avail of this relief. Revenue can't take it back off you. You're availing of it in the year. There's no buyback on it. And ultimately, there's a potential tax saving of 2,600 on just a 5,000 euro increase in stock. I suppose, as a general rule, any farmer can avail of 25% of a stock relief over where there's an increase over and above the opening stock. However, if they're in a partnership and all the makings of a registered farm partnership is there, they can still explore the possibility of moving to a registered farm partnership still to avail 50% stock relief. On a 10,000 increase in stock, that means a 5,000 euro stock relief. And equally, where you have a young trained farmer that are in, it's a great opportunity to avail of that in 2025, given the high prices, and to minimise the tax gap in the future. So just to explain the impact of, or the importance of tax values and how it can push out tax bills to the future years if they're not set at the right number. So in the example here, if we have cattle valued at 1,200 euros per head versus 1,000 euro per head, and we can see the difference in the tax liabilities. If we say that the taxable profit in 2025 will be 22,000 at a 1,200 euro closing tax value, that would increase, or that would result in 13,000 then estimated of a tax liability in our taxable profit in 2026. Equally, the lower the tax value in 2025, which might seem like a good idea now, you're just kicking the can down the road, and it is going to be caught at that point in time in the future. So it's not a case that you're saving money by having a low tax value. You're missing out on a valuable stock relief, and you're only pushing out the tax liability to the future years. Okay. Moving on to the accelerated capital allowances, which is an area that a lot of farmers are exploring this year, given the expectation of a high tax year, how the year started off. Solar panels, energy efficient equipment, and covered slurry storage are two things that have been extremely popular, and that a lot of people are investing in. So with solar panels, it's recognised as energy efficient equipment, and as a result, where normally capital allowances are spread over 8 years, they are accelerated, and you get 100% deduction for them in the year of purchase. Now that's net of grants and net of VAT, just to be mindful of. But if given the high price in 2025, it's a very effective way to manage tax if you've made the investment. Similarly with slurry storage, it's over 2 years as opposed to the normal 7 or 8. And it's 50% per year. It's not just restricted to tanks, but it is covered storage. So included in that, you have automatic slurry scrapers, you have collecting yards, you have the covered animal housing and slurry stores. So there is a number of opportunities there to avail of accelerated capital allowances. Okay. Now, everybody's probably or hopefully familiar with normal capital allowances. So for plant and machinery, the likes of tractors, etc., it's at 12.5% for 8 years. So that's if you're VAT registered, is net of VAT claimed and any grants that you've received over 8 years, the year of purchase. Equally, buildings, it's net of VAT claimed and any grants received, and it's 15% of the cost of the remaining cost for 6 years and 10% in the 7th year. So both are extremely valuable. What we do try to encourage is that we don't have a massive amount of investment in 1 year and that it all times out together. But in years like 2025, that I suppose if there's investment to be made, it's the year to do it in order to bring down the tax bill. Just to be mindful of where I suppose a lot of questions are being raised at the moment in terms of, will I change the tractor? Will I change the car? What will I change to get down that tax bill and take advantage of the year that was in it? To be mindful that if you trade in an asset that you make a profit on, say it's worth nothing for tax purposes, but you get a 20,000 trade-in value, that's put against the cost of the new asset when it's traded in. However, if you choose to sell that asset and subsequently buy a new one, the 20,000 that you receive is treated as profit So the knock-on effect is you could actually wipe out your capital allowances by not structuring the transaction properly. So just be mindful that, I suppose, if you're looking to sell an asset and you're selling it for over and above what it's worth for tax purposes, that is a potential profit. Moving on then to family wages, there's a massive opportunity here to spread the load between family members. We all know farming is a bit of a vocation where the whole family is involved, and it's not always possible to recognise the contribution of all the family that help out, that go out in the evenings, that are doing all the work. So there is a huge opportunity here to recognise their contributions while availing of a tax deduction for the money that you're paying across. Now, ultimately, in a lot of situations with kids, you're paying the money anyway. You're paying the money for going to college, you're paying for school, but you're just not getting the tax deduction on it, even though they're doing the work on the farm. So it's about being working smarter, not harder, and putting that through payroll. So being mindful, I suppose, of the limits, that we don't want them to incur a massive tax liability either, while being fair. Earnings under 13,000 are exempt from USC, and earnings under 20,000 are covered by the tax credit. So that's by the 2025 rates. Now, under the POE modernisation rules, the payments to family members when family members are put on payroll, it's required to match the payments that are made. So payroll should be run every time that a payment is made across to a family member, as opposed to the old way where it was just done at the end of the year, maybe to catch up on the money that had been paid across. But I suppose if you have kids coming up to college age that they're going to be looking for the first car, by putting wages through, you're incidentally just getting tax relief on the money that you're paying them across for that in the run up to them going. It's potentially class M if they're living at home, which is exempt, that there would be no PRSI cost. But just to be mindful of, if it's class M, they don't receive a PRSI credit. And that's important, that in terms of a contributory pension in the future, you have to have 40 years of contributions, and at class M that wouldn't give you any contributions towards that. Now, for anyone that is aware of auto enrolment, which is the new government pension system coming in January, there is an exemption available for auto enrolment depending on the employee or family member's age and their income levels. So you wouldn't automatically get caught by that once you stay under the relevant limits. So just to put it into monetary terms, by paying a family member 8,000 in wages, there's a potential tax saving of 4,160. So definitely worth exploring. So another area that is, I suppose, sometimes not thought about is a spousal partnership, or indeed a partnership. So if a spouse has no earnings in their own right, it's maybe more tax efficient to use their portion of the standard rate band, i.e. up to 35,000 at 20%, rather than it being taxed at 40% in the sole trader's name. It's also a useful way to increase the spouse's PRSI contributions for the contributory pension that I just mentioned. But also, it doesn't have to be a spousal pension. There's an option there that if there's a child or niece or a nephew working on the farm that you mightn't necessarily be giving full entitlements to in terms of wages, that there's an opportunity to bring them into a partnership. Essentially, by going into a partnership, be it an unregistered partnership or a registered partnership, you're spreading the load out of the tax liability. So where now you might have a standard rate band of 44,000, or if married, 53,000, you are potentially bringing in two or three standard rate bands of 44,000 each. That's a substantial tax saving by bringing somebody in that's already involved in the farm and just given due recognition. Now, if it's a case that you're already in a partnership or you're akin to a partnership, there's also an option to explore a registered farm partnership and avail of the higher stock relief. So there's massive opportunities here where they're not being availed of in terms of recognising people that are working on the farm, but also bringing spouses into it to maximise the tax efficiencies. Now, pension contributions, little bit Marmite. Some people love them, some people hate them. But what we can't deny is they are very effective at reducing the tax bill, reducing preliminary tax obligations. The recent IFAC report has shown that 1 in 5 farmers can't afford to retire due to pressures on the farm supporting 2 generations. Like that's massive. That I suppose a lot of people are caught continuing to farm when they should have passed on to the next generation. So there's a massive opportunity here to start investing in a pension and availing of the tax reliefs that are available. So tax reliefs on pensions that are determined by your earnings and your age. So for somebody, say in the 40 to 49 tax bracket, they could avail of they can contribute up to 25% of their earnings into a pension to a maximum of 115,000 max earnings. And if relieved at 40%, the idea behind it is that in the future, you would draw down 25% tax-free lump sum, and at that stage that you would have retired, and hopefully draw down your annual distributions at the standard rate, which is 20%. So ultimately, what you're saving by putting into a pension is your 25% tax-free lump sum, and hopefully that once you've retired, when you draw down, that you'll be paying tax at 20%. So the difference will be the 20% tax relief that you would have availed of while working. So potential tax saving on a €5,000 pension contribution is €2,000. Now, equally, if you're paying preliminary tax, that €2,000 is knocked on as well. So your cash outflow might decrease by €4,000 as a result of a €5,000 pension contribution. So moving on then to tax credits, which seem like very, very basic, but again, Revenue have reported that a lot of people are not availing of these and are not claiming them back. So medical expenses, they're available at 20% after the reimbursement from the health insurer. Nursing home costs, the cost of a carer, employing a carer, or using a nursing agency are available at the 40% rate. Now, I suppose in terms of people who are looking after parents, I suppose it's about spreading over those costs between siblings to try and maximise the tax efficiencies as well, in order to get the 40% where you can. Equally, with the medical expenses, what's not allowable is routine dental and routine ophthalmic care, but the likes of GPs, pharmacy, physio, consultants, diagnostic tests are all allowable, hearing aids, things like that. The next one then, rent credit, very relevant for anyone with kids in college, especially that they're paying rent for their kids, albeit in college accommodation, private accommodation. It's 20% of the annual rental cost for up to €1,000 for a single person or €2,000 for a couple. So extremely beneficial. One of the things that we're asked is what happens if I'm paying my son or daughter the money and they're paying it onto the landlord? Well, I suppose ideally you would be able to show the paper trail paying the land because you are funding the rental costs. So ideally you'd have a receipt for making the rent payments across. So just to structure things a little bit differently so that you can avail of that rent tax credit. It's very valuable. Equally with college fees credit, it's also 20%. The first 3,000 is disregarded, but if you have more than one child in college, there's only 3,000 disregarded. So again, it's all about structuring that in the right way. Now, VAT 58, where I've put this in is just for everyone to be mindful of the option. So if you're incurring expenditure on land reclamation, fencing, drainage, or anything that you can claim that back on, you need to weigh up and you're on the fence whether it's repair or restoration. You need to weigh up whether you can expense it in the 1 year and forego the VAT, or whether you claim back the VAT, but in which case you have to spread the cost over 7 years through capital allowances, similar to buildings, like we saw in the earlier slide. So I suppose if you forego the VAT, you can claim it in 1 year, but if you claim back the VAT, you're spreading it out over the next 7 years, the tax relief on the cost of it. Equally, the cash flow considerations on claiming back VAT via VAT 58 in a timely manner can assist with paying the income tax bill. So just to be mindful of that, very common to speak to people saying that they've built a shed, you have to claim the VAT back, and they haven't even gotten around to it. So all that money is just sitting there, easy pickings to low hanging fruit to get that money back and help pay towards the tax. Now, limited companies, obviously a little bit of flavour, they're in vogue at the minute because of where the prices are at and where the profits are. It's very late in the year to be going into a company. If you were to go into a company for 2025, the knock-on effect is you would pay tax on an actual basis, so the actual profits from January to now, are until the point that you go into the company. Now, that's fine if you've always been taxed on an actual basis, but if you've been taxed under averaging, for 2025, your tax bill would actually be a lot higher than you expected, being taxed on the actual basis. So it's very unpredictable to know what way the prices are going to be in the future. So it might just be a plaster on a short-term price increase. Hopefully not. But I suppose crystal ball situation. One of the main considerations before considering going into a company is what level of profits are still available over and above what profits you're making, over and above what drawings you're pulling out every year. And if it's a case that there's a substantial difference between your drawings level and where the profit is at, there's potential there to avail of a 12.5% rate as opposed to 55% that you're potentially paying now. Now, just to be mindful of going into a company, you would lose the buildings allowances, so just to weigh that into the decision-making process. So it's not a very straightforward decision to consider going into a company in 2025, especially at this late stage. Now, in terms of cash flow considerations, obviously, but in order to maximise deductions available in 2025, I'd obviously be encouraging everyone to make sure that they're paying everything via cheque, via bank transfer, getting an invoice, and avoiding paying cash for any expenses. One, obviously, you're not able to account for all the expenses going through the business, but two, it's actually costing you a lot more because you can't get a tax deduction for it, and ultimately you still could be paying just slightly less than what the market price would be. So it's going to end up costing you a lot more by not being able to claim the tax back on it. Just be very mindful of that. Next option, or the other cash flow consideration, is just your preliminary tax options to be mindful of. So everyone, I suppose the most common method of paying your preliminary tax is 100% of your current year tax liability. So right now, everybody's probably paying 100% of their 2024 income tax liability. What that leads to, I suppose, is the potential of a double hit this time next year, where you're paying your balance of tax for 2025, but you're also paying 100% of your total 25 tax bill for preliminary tax 26. To make you aware of your preliminary tax obligations, or your preliminary tax options, you can pay on 100% of your 25 tax liability, or you can pay 90% of your estimated 26 liability at that stage, or you can start in January or at any point during 2026 paying monthly direct debits. And under that option, you could actually pay 105% of your 2024 tax liability. So I suppose while, again, not a tax saving, it's a cash flow mechanism in order to spread the load out and not have money sitting in revenue waiting to claim it back in 2026. So just be aware of all those options. Yeah, so thank you very much for joining. And has anybody any questions?
Brilliant, Aisling. That was a super presentation. Mark, you're probably handling the questions more than me there. Have you any coming through in the Q&A?
Yeah, there's a few in there, so keep them coming. Yeah, the first one there, I suppose, maybe on the capital allowances end of things. What maybe for both of you actually, what would you say maybe is the best investment to improve the efficiency on the farm and also to get the best return on that investment long term?
So it would depend on, I suppose, what your farm system is ultimately. So it would come down to that. It is on a case-by-case basis, but straight off the bat, like you're looking at solar panels in order to decrease those ESB bills. You're looking at if there's a need for slurry storage to start making the investment now when the accelerated capital allowances are there. But like ultimately, I would say solar panels are one of the biggest investments. You can see the improvement they've made on ESB bills once they're done with the right storage. So that'll be my recommendation.
Yeah, and if I was just to add to that, Mark, I suppose look at it's something we're saying every year, but God, if there's surely a year for spending money on lime, this is the year. Like lime is the backbone of growing grass and of efficient production. So lime has gone up a bit from the good old days. So people haven't bought it for a while. It's probably 30 to 35 euro a ton. The best money you'll ever spend. So absolutely, I mean, we're in good weather currently. I'm not saying it's going to last forever, but super chance to get out lime over the next, try and get out straight away, but over the next month or two, it's a great chance to do that lime. So that'd be one spend we'd say is absolutely, you're mad not to do it, and this is the year to do it. Another thing, look, we're not big into pushing people to buy machinery, particularly in the beef enterprise, but I have seen a good few farmers going for the 60% grant for that bale slice plastic remover. So someone would have, if they have a lot of plastic, a lot of silage bales, that might be one option as well. And have some little bit of saving, but lime is always first, second, and third in our offerings.
Okay, yeah, both great investments there. All right. While you're on there, Terry, one for you. What would you recommend if in for finishing cattle over the winter if the silage analysis came back a bit on the poor side, maybe not where you'd like it?
Yeah, and look at this. Is a disaster there for a farmer, and we've got a number of samples back in the last week with the beef welfare scheme. Results, yeah, in general, good. You know, what you'd love to see is your silage results coming back around 74% DMD, and there's some farmers, religiously can do that. But I think, Mark, if I had silage results coming back at say 64% DMD, and I want to be at 74% DMD. Well, look at it's really it's going to be a tough winter for you. The reality is that the most expensive thing for the winter is A, not knowing your silage, and then not feeding your cattle accordingly to get the weight gain. I mean, with the price that cattle are making now, a no thrive or a poor thrive winter is the dearest of all. So look, if I had poorish silage or middling silage and I was finishing cattle like the butchers I showed you, effectively you're moving on to nearly an ad lib meal system with very little silage or a bit of straw maybe in its forage. If you have weanings there and you had mid 60 percent DMD silage, look, the reality is you're going to have to go in there with at least 3 kilos of meal for a good half of the winter. And the only thing more expensive than feeding the 3 kilos a meal is not feeding the 3 kilos a meal if you have the poor silage. And obviously try and put more emphasis into making that quality silage there next year to lessen that feed bill and get your performance without having to make it up by concentrate.
Okay, thanks, Terry. One for you, Aisling, I think. Can solar panels be installed at an address off farm? So maybe from a
Realistically, no, because they have to be for the use of the business. So if there's a way of utilizing the energy off them for the farm, then yes, but I suspect that they would have to be on the farm in order to get the benefit of them.
yeah, and probably from a Tom's Grant point of view too, they'd have to be on the holding. Another one there, Aisling, would you recommend claiming the VAT back on fencing as soon as you buy the materials?
So again, it would have to be quantified. So minimum charge back would be 125 euros of that. So you'd have to take that into consideration. But there's nothing stopping you claiming it back in the current year. But whereas revenue encourage, if you're claiming back for previous years, that you only lodge one claim per previous year.
Okay, and one more there for Terry. I got poor weight gains on store cattle last winter with what was good silage. What could have gone wrong there?
Yeah, look, and this can happen. I suppose what we'd have tried to sort of an analogy we could give to people for wintering cattle, it's like the three-legged stool, Mark. So, nutrition is obviously one hugely important leg, but equally the environment and the health of your animals are the other two legs on that stool. And you won't sit on a two-legged stool if one leg is wobbly. So, I mean, if you don't have the environment right, and we're talking about ventilation in the shed, no drafts, nice airflow. But a huge thing I'm seeing on some farms is too many cattle in a pen. So if you're overstocked in a pen, it's game over, no matter how good your silage is. And on the whole health issue, look at farmers in general are very good at the health thing, but just if you're wearing a fluky year, that those fluke products, the timing of the product is hugely important to get that right. But look, just think of it that way. Nutrition is hugely important, but the other two things have to be spot on as well, or it's game over.
Okay. So just one final one there, unless there's any more coming in. For Aisling, I think you mentioned partnerships and spousal partnerships in particular. Can that be set up now for the 25 tax year, and is there a cost involved there?
It can be, and once it just has to be in place for 31st of December, so there's no issue setting it up now. And in terms of setting up a spousal partnership, especially, there wouldn't be little to no cost of setting it up. You'd have to review your individual circumstances to make sure that if you're in averaging, that you don't have to have a clawback or anything like that. But ultimately, it can be done now. Yeah.
Okay, Terry, that's all the questions I think at this stage.
Great stuff, Mark. Look, thanks for that. It's gone after 9:15. We said we're trying to keep these to 45 minutes. So, look, I'm going to sort of wrap it up at that. Just to outline that our next webinar, Tuesday of next week, the 21st of October, it's Dairy EPI and understanding the recent changes. And we've a couple of the advisors on to go through that. But just to conclude tonight, the first webinar was a beef webinar. The third webinar will be a beef webinar as well. I think tonight, there was a great crowd on. We're delighted with that. So the webinars are working and people don't have to travel. Huge, huge thanks to Aisling. It was a superb presentation. I've never seen something that's explained so well, and it's a complicated area. So, I mean, there's huge food for thought there in that, and to help you in your plannings for this year. So, Aisling, superb thanks for coming on to do that for us tonight.